Well, the short answer is not at all. So I know that's a popular narrative, and it's very intuitive because labor markets are getting tight. We're seeing unions ask for more money. I think you're seeing some wage pressure in the US and the UK. But if you just look empirically, how much wage growth you need to actually generate subsequent price pressure, it's just incredibly small. So you need about, as a rule of thumb, across the whole universe that we cover, you need 100 basis points of wage growth to generate 4 basis points of price growth. So all these things are correlated, but to actually create a spiral is something completely different. And so I think people are sort of taking their eye off the ball. If you worry about how am I going to be wrong on my inflation forecast next year, it's not going to be wages or the output gap or how tight the labor market is. It's entirely down to the bottleneck pressures.
So if we get an 8.6% reading on PPI today, which is pretty much what's penciled in, and something that's got a 5 handle on CPI, you buy bonds on the back of that because that's as peaky as those numbers are going to get?
No, it's got a few more months to go, actually. So I think there's a few important points to make. So one is that, the higher the prints are now, obviously the more difficult it will be to repeat those next year. So it's creating massive base effects. And so the way we're thinking about it is that every time we get these upside surprises, and we think this is going to be another big one actually on the next print, then next year it just means inflation needs to go lower. Now, that's not the way the Fed has been incorporating it into the forecast. So I think the near-term risk actually is that their forecast in December is going to have to go up even more. And as they do that, they'll have to carry some of that over into next year's forecast and the forecast after. And that creates sort of a hawkish backdrop to potentially accelerating the liftoff. And so that I think is where the market is. The way we're thinking about it is that you've got another 3-4 months or so of pretty intense bottleneck pressure. You're seeing OER ramp up, which is just lags. But by the time you get to early next year, you're going to see a very substantial sequential deceleration in inflation. Now, you will need to sustain that deceleration for quite a while, basically in the taper window, to convince the Fed that they don't need to lift off. But we're basically at this stage already about 70 basis points below their forecast for core PCE next year, and it'll probably go up in the December SEP. So we say, don't worry, but I think the problem is from a trading perspective, the near-term pipeline I think, skews hawkishly, both from an inflation perspective and a Fed forecasting perspective.
Arend, I want to get into the labour shortage issue with you, and it feels like it's more than just headlines here. I was talking to someone who runs a very large services business, a hospitality business here in the UK, and he said to me, look, you just cannot get into a bidding war at this point because it's not sustainable. And down the track, when you can get workers at a cheaper rate, then you just substitute. In fact, what they're trying to do is attract people with perks, but also with the promise of some form of sustainability around the job. How much of that applies to the States as well, away from just some of these big businesses that can afford to pay up because they have volume, to some of the medium and smaller businesses that can't get into this bidding war?
Yes, there's a few interesting things going on. I think one is that if you look at the US and look at sort of the broader universe of developed markets, then in general, even goods employment, which is the sector that is overheating and where all the shortage stories are coming from, is not yet back at a pre-pandemic trend of employment, right? So, which really sort of to me signifies that this is more of a supply than a demand problem. Now, in the US, it's also clearly a demand problem. But so there is still, I think, resistance for people to come back. And also, because those wages are now going up, I think there's some optionality for people to wait. And then to your point, it becomes sort of this waiting game where the businesses are getting more and more desperate. The workers, I think, are at this stage still able to hold out, partly because they, in some cases, had some decent benefits. They've managed to sustain their income support, and they're seeing these wages go up. And so they're partly sort of waiting for the right thing to come along. Now, that cannot last forever. Basically, I think, the notion that these people, take the US as an example, the notion that these people had made lots of money in the stock market and had all these transfers and now basically can retire, it just mathematically is completely false. So I think we're in this friction phase now where clearly there's some worker discouragement. There's still some COVID fear. There are some childcare issues, which we're seeing the tail end of now, which are starting to sort of dissipate. And then we think that over the course of the next sort of 6-9 months, these people will start to come back and then these wage pressures start to go down. But we're still in a difficult phase here where we're generating a very skewed distribution of demand into effectively one large goods and manufacturing sector. and it's very difficult to sort of resolve that near term. Now, the other thing I think that could happen, which I think is a bit dangerous for, I guess, for employees, is that what we're starting to see is that firms are reacting to those bottlenecks by investing more. So ultimately, if you look at what happened in this crisis, you had capital labor ratios completely thrown out of whack, mainly because people got fired. And then the way, in the recovery that's supposed to restore itself is that you rehire those people and then you go back to balance. But because the employees are not coming back, the firms are now basically having to invest and buy more machines and robots and equipment to basically substitute for that labor. And that potentially means that on a more permanent basis, you start to lose some of those jobs. And we're seeing that I think to some extent in the US, where CapEx intentions are now running at 20-year highs. And it looks, despite the fact that we think a lot of these demand pressures are temporary, firms are starting to extrapolate from that, and they're having to make these investment decisions because they can't find the labor.